It's starting to break. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, serious problems in the shadow banking system indicate that the next crisis has now started as we're seeing a surge in defaults, which is something we're not supposed to see happen in this space. We're going to take a look at what's going on inside the shadow banking system, what this means for the real estate market, and why it indicates that the global financial system is starting to break. And are small businesses overly optimistic as we head into the summer season? We're going to show you why a lot of problems are going to face these businesses as there are signs the U.S. consumer is cooling off in a major way. And are the energy markets suggesting perhaps the economy is in far worse shape than we thought? Well, the signs are actually far gloomier than even we thought. Let's head over to Zero Hedge, where we picked today's story up with a headline: Chinese developers resorting to negative down payment practices. Now, I want to lead you into what's going on in the shadow banking system because the problem is starting in China. So anytime, and you may recall back into the global financial crisis, before that, there was all kinds of suspicious lending practices going on. You remember those ninja loans, no income, no job, no nothing, and you could still buy a loan on get a loan on a very expensive home. Now, I want you to see what's going on here in China because this is going to open the door to the major problems you're seeing in the shadow banking system. China's real estate agencies have been quietly resorting to some of the oldest tricks in the U.S. housing book, such as marketing home buying with zero down payment or negative down payment, so consumers don't only need to pay the down payment, but also, get this, contain funds for future renovation. Of course, we know, going back into the financial crisis, anytime you're pumping prices up, they're doing it because the market is already overinflated. They've got inventory they need to unload. They know they're getting down to the marginal buyers, people who shouldn't be buying homes at all. But when you offer them no money down deals, or in fact, hey, we'll give you some money back, you can go buy a new home theater, that car, do some renovations, put the landscaping in, you know you're getting near the peak of the market. We know we're not far from seeing the bubble burst. And in China, as we've talked about in the past, the real estate market there is super sketchy and could take down not just their financial system, but the entire world. As for the so-called negative down payment, the report said it is executed through developers using down payment installments and returning down payment to buyers, or setting relatively high contract price for consumers to apply for a larger bank loan. If the funds returned to the buyer from the developer or the bank loan secured against the property exceed the original down payment, the negative down payment is achieved. So this is pretty simple. Imagine going to a home builder and they've got a house, say, priced at $400,000, but you actually know you can buy it from them for $450, and they're going to cash you back the 50 grand on top of that. You get the loan for the $450. That's kind of what's going on here, is they're overinflating prices and getting appraisers and the banks to go along with it. And now you start to understand that when the housing market starts to collapse, and we know in China it's going to happen at some point, because of the globally interconnected banking system, it's going to have feedback effect across the entire world and even to the major U.S. banks. The so-called negative down payment is essentially the creation of a fictitious purchase agreement, which in turn inflates the purchase price of a home in order to fraudulently obtain a larger loan for the down payment. And that now leads us into our headline story: why China's banking system has got a problem, as we see their shadow banks defaults are now starting to surge. Of course, we know in the U.S. here, a lot of loans are being originated out of the shadow banking system. So whatever starts to go wrong here is a leading indicator of what is to come to the rest of the system. And with the U.S. already experiencing problems here, and now China starting to see issues, you can only see this is quickly going to be a global issue. A town builder's last-minute bond repayment reignited fears over a potential default by such issuers, and investors are watching out for the first missed payment by a local government financing vehicle, something regional authorities are trying hard to avoid. Research shows that there were 73 cases of shadow banking defaults in the first 4 months, already a full-year record since the data became available in 2018. And missing payments in the shadow banking system are a signal that debt risks in a certain region have become more prominent. Of course, we know know, in China, a lot of money gets borrowed and put into major housing projects. So when you start to see an increase in defaults, remember, we've been talking about this in prior shows. Sometimes it's not always about the number, but the rate of change. In this case, the rate of change is up, and so is a headline suggesting that we have a tight money system. There is a shortage of money, whether it be dollars or yuan. You're starting to see that, and when this thing starts to snowball, there's no stopping it. And with the financial strength of both town builders and their sponsors deteriorating, investors became more pessimistic about China's demand for raw materials, of course, validating what we've seen in the metals market. You know, we've seen aluminum prices, copper prices, zinc prices. I mean, you go down the list and you're seeing prices come down at a time when everyone believes the global economy should just have a soft landing or a no landing and then come bouncing out of there. But yet here we're seeing in China, which is everyone's hinge, the global recovery on, is struggling, and not in a little bit of way, not just a slowdown here and say, hey, we're missing our spending targets. We're seeing defaults rise up again. Remember, we almost had this happen back, a couple years ago during their major problems there with the real estate market. It's back, suggesting, as we've been saying on the show, central bankers will have to cut rates, governments will have to step in. The question is, can China stop it this time? What do you think? Weigh in the comments. Do they have this thing under control, or is it going to spiral out of control? Because things in the U.S. here as we head into the summer aren't looking so hot. Restaurants expect strong sales this summer. Consumers aren't so sure. And of course, we can recall here that we've seen a lot of businesses, particularly restaurants, hiring. They're expecting a big demand. We know during the summer months, a lot of business do a lion's share of their revenue because they have to get through those lean winter months. But let's take a look at how optimistic they are, because I think operators are still hopeful for a good summer boom in foot traffic and sales, but I think on the consumer side, they're more hesitant. Last year, consumers pulled back on their restaurant visits in May, June, and July amid inflation concerns. In addition to higher restaurant bills, diners were also paying more at the gas pump and in the grocery store. Now, as we've been talking about on the show, the key part here is what happens to discretionary spending. So when you see grocery bills goes up, you see gas prices go up, what do you have less money of? And that's discretionary spending, and that's where the restaurant side focuses on, because if people don't have enough money for groceries and gas and rents, they're certainly not going to go eat out. That doesn't make any sense. So the question is, are we seeing inflation being impactful enough here? The answer is absolutely, we're seeing it. But one thing that you should have some confidence on is your trading account. Now, if you've missed out on this tech rally, you shouldn't have had to do that. Our CTA-Timer Pro, it looks at the machine positioning, runs a historical overlay against all the data, and you can see it first told you to start buying here. Now remember, we're even higher now. I'm taking a shot from today's trading screen, and then if you missed that one, there was a second one. This thing will reignite how you trade. It'll tell you when positions are at historical short positions where you need to be looking at buying in on a reversal. This one from our January 9th report. The next one on March 15th said, hey, the machines were buying up again. We kind of mentioned that to our subscribers. So look, you've got to get in on this, because I'm telling you, for $30 a month, it will show you the things to focus on. Start making winning trades from the bottom up. That's the way we want to do it. Again, link in the description below for the report. Let's continue on. Roughly a third of consumers served by Data Essential plan to dine out less over the next month, and about half plan to maintain their current restaurant spending habits. The question is why, as inflation and the economy are still more top of mind to consumers in terms of their financial planning, rather than any sort of fun or anticipation for travel. So they're trying to figure out what's going on here, but the issue is still inflation. And I want to show you the effects of inflation on the discretionary side, and let's focus here on the restaurant business. And here we can see on this slide here in blue, we have advanced retail sales, specifically retail trade and food services, against the broad headline consumer price index. And lo and behold, what do you see during periods where red, this is a CBI, is running hot? What happens to discretionary spending and food services starts to slow down and decline. You see that going into the global financial crisis. Too hot inflation, money had to come out of some budget, comes out of discretionary. You see it here again around 2012, you see it around 2018, and now you're seeing it now. I mean, it's not just an issue of pure inflation, because you start to see the restaurants have really had to raise prices a lot. I mean, they got hit across the board, and now they're facing having to hire or raise wages to attract more services people to work, the employees, and it's just causing the bills to skyrocket. Many people are looking to eat at home saying, hey, you know what, I can do this for a fraction of the cost. What I'd love to know, have you cut your eating out to eat at home because prices are too high, or is it not a big deal for you? What do you think? Let's weigh in on that. As the National Restaurant Association issued a cautiously optimistic seasonal forecast, as bars and eateries, get this, will add more than 500,000 seasonal jobs this summer, assuming lawmakers raise the debt limit, which they're likely to do, as we've been saying. If the restaurant industry meets those expectations, it would be the strongest hiring since 2017. So here again, you see everybody's making a bet on the recovery, and what we're seeing in the consumer sentiment data, which we'll get to in a moment, is suggesting that consumers aren't as financially strong as we thought. And that means for the restaurant business, the discretionary side of the economy, they're about to get hit with a slowdown. Instead of all this hiring that they're going to do, well, if they do that, those might be back on the unemployment line before we know it. At the same time, most restaurants' profit margins are improving as they keep pushing prices up. So some are pivoting to value meals and other deals to draw in customers, indicate when you have to cut your prices to bring people in, you have a demand issue. And given where consumer sentiment is today, some of the data we're seeing, we do feel we have to be a bit more value oriented because, again, consumers aren't in that great of a position. I know we keep hearing from the banks that they're sitting on mountains of stimulus money still. The reality is most people spent all that money. They're still having trouble with their wages keeping up with inflation, and they've taken on a lot of debt since the pandemic. The recipe for disaster on the side of the discretionary economy is huge here. Let's take a look at how consumers think about the economy. If we look at the University of Michigan's inflation expectations remain at 12-year highs. This from Zero Hedge. As consumer sentiment, let's start there, slid 7% amid worries about the path of the economy, erasing nearly half of the gains achieved after an all-time historic low from last June. The decline mirrors the 2011 debt ceiling crisis, in which sentiment also plunged. The question is, do you believe the sentiment is plunging because of the debt ceiling? I don't buy it. I think it's just how people are viewing the economy right now. And you can see that in this survey here. Buying conditions for homes, vehicles, and large durables all turned back lower, suggesting that this kind of euphoric time in the recovery phase of the economy is now over, and it's ending at the worst possible time. Now let's take a look at what this means for retail trade. Here we see the University of Michigan consumer sentiment in blue against advanced retail sales in red on a year-over-year rate of change. And what do we know? As consumer sentiment falls, what happens to retail sales? They decline or contract, as we're seeing here during the global financial crisis. And then we're seeing this happen again. It's just a function that when consumers are not confident about the economy, not only do they not eat out, they don't do a lot of discretionary spending. They cut all of that back. They focus on what they have to, the staples, and the rest goes to debt repayment, goes back into savings, just because they're afraid that the whole thing could get a lot worse. The most important segment of the University of Michigan survey continues to be inflation expectations, and what we can note is they've dropped from their flash print from 4.5% to 4.2 on a one-year basis and 3.2 to 3.1 on a 5 to 10 year. But is it likely to come down some more? The answer is absolutely, because the inflation expectations are more a function of gas prices. Now we're seeing expectations rise as we head into summer months where people believe gas prices are headed up. And the question is, will we see demand fall enough in the summer travel season? Will we see gasoline prices continue to fall? Because when we start looking at the energy market, it's telling us global demand is slowing, and not in a small way. Oil ticks up. This from Monday as markets weigh U.S. debt deal rate hike possibility. We're going to look at that in a moment as the euphoria of the debt deal is wearing off as concerns mount for another rate hike by the Fed in June. Of course, you might be wondering what rate hikes have to do with the energy market, and the answer is, well, nothing. And here you can see crude oil prices against the federal funds rate. We can note there's virtually no relationship here. Oftentimes, energy does tend to fall ahead of a steep decline in the federal funds rate. And that isn't all the time. We notice the Fed going into the global financial crisis did cut rates as oil surged and then came crashing down. But most of the time, we see prices start to head down. And as of the time of recording, we're back under 70 a barrel, indicating that there is a problem in the global economy. There is a demand issue. and is going to cause gas prices to come down. Because remember, where WTI goes, West Texas Intermediate, gas prices are going to follow, and we know inflation expectations based on the University of Michigan's survey data and gasoline prices suggest that inflation expectations are also likely to come down here. But what is the driver if it's not the Fed? Well, what's causing, of course, this lack of demand from the energy sector? Well, we already know the answer. That's the yield curve. So in another great indicator here, we can see periods where the yield curve inverts and starts to steepen. It tells us financial conditions are tightening. It tells us interest rates are coming down. It tells us the economy is slowing. And we can get these move higher in crude oil, as you see in blue, but it then comes crashing down. But most of the time, you see the inversion immediately followed by a decline in energy prices, which would actually make sense here. Of course, the global financial crisis, we saw a steep rally after the inversion kind of brought oil prices down, and then they took off. But as a general rule, what oil prices are responding to here is a slowing global economy, a slowing U.S. economy, and at $69 a barrel is not telling us inflation is going to be a huge problem for a whole lot longer. At some point, we're going to see the CPI come down in a big way. And speaking of things coming down, U.S. home prices show annual decline for the first time since 2012. After an unexpected and small blip higher in February, U.S. home prices, according to the Case-Shiller composite, were expected to continue their decline in March, and they did. Here we see they dropped 1.15% month over month, which is a pretty sizable drop, and on adjusted, non-seasonally adjusted basis rose 0.45% month over month. But check this out, the year-over-year rate of change is now negative. Again, all of this is suggesting that inflation is not going to be a long-term problem. The issues we're seeing in China's shadow banking system, if they get out of control, if the government doesn't step in, if the central banks don't step in and put a wall around this thing, and at some point it will get too big for even them to stop, it's going to spread like wildfire across the global banking system. And with the U.S. banking system already having problems as is, it's only going to get a whole lot worse real fast. And that's why we're starting to see the beginning. It's all starting to happen. And that validates it. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.